Investors have been conditioned to ignore the currency markets as of late due to historically low levels in volatility. The three primary currencies in the global economy are likely the US dollar, the euro, and the British pound. The dollar and the euro have been trading mostly sideways for well over a year. While the greenback has maintained a relatively lofty value, the euro has been trolling lows in a tight descending trading channel. Nevertheless, we've been doing this for a long time, and we know that quiet currency markets never last. They're always temporary. It's not if volatility will return, it's when it returns. And in our opinion, when volatility does return, it will probably be conducive to trend reversals. In other words, we're looking for the dollar to roll over and head lower, and it should be bullish for other currencies that have suffered relentless selling, such as the euro and the British pound. If you're thinking of tuning out because you're not a currency trader, think again. Regardless of the asset you're trading, whether it's traditional investments such as stocks or bonds or even commodities, currency correlations do matter. For instance, if the US dollar weakens and the euro and the British pound strengthen against the dollar, it will likely put a damper on stock market gains in the US, and it'll likely have a similar impact on treasuries, lower treasuries, higher yields. If you look at the relationship between the U.S. assets and the euro, the relationship is decidedly negative. Specifically, the S&P 500 futures and the 10-year note, the 10-year Treasury note, have settled in the opposite direction of the euro, roughly 70 to 75% of the time throughout the previous 180 trading days. Commodities, on the other hand, generally get a boost when the dollar weakens. Despite the fact that we've been relatively range-bound in currencies, the global theme has been consistent. Buy the dollar and sell the euro and the pound. There's a plethora of reasons for this, including Brexit, but one of the major driving factors is the interest rate differential. Global investors believe they're better off buying the US dollar to purchase US-backed securities for allocation into treasuries than they are buying the euro to earn negative yields on fixed income products. However, there comes a time when the fundamental story becomes conventional wisdom, when everybody's thinking the same thing and everyone believes the same thing is going to happen. At that time, the market generally starts seeking another story. In our estimation, we think such an inflection point is nearing in the currency market. If so, the euro could be putting in some sort of significant low and the dollar a significant high in the coming weeks to months. To be fair, we thought this would occur far sooner than today, but with the euro approaching trendline support and oversold oscillators, we feel like it's a good time to express this opinion. That said, we would never recommend anyone bet the farm trying to find a bottom or a top in any particular market, particularly in this one, in which we've seen the market trolling lows for quite some time, well over a year. Looking at a British pound chart, we can see that the British pound put in a post-Brexit low around 120, not long after the Brexit vote. Since then, it's put in a high of about 145. The way we look at this is the 120 low is probably the market pricing in some sort of worst-case scenario, whereas the 145 high was probably some sort of best-case scenario. If that's the case, it makes sense to assume that the British pound will find support somewhere in the low 120s. While we don't necessarily expect to run all the way back to 145 right away, we do think it is in play in the long run. In the short run, we think the low 130s or mid 130s are probably a good target for the bulls. Looking over to the euro, we see a similar chart. It makes sense because the euro has also been impacted by the Brexit vote, and we also are seeing the euro being dragged down by an interest rate differential. However, we have to believe that we're getting close to a situation where most of the bad news is already priced in, and the euro might have a chance to at least bounce out of the hole. Initially, a bounce might run into some resistance around 113.75 or so. If we can break above that, we think the euro might get a pretty good rally going. 114 to 115 will be a slight barrier, but ultimately we think a move to 116 is possible, maybe even higher if the fundamentals really flip.